and welcome to a brand new show of Crystal Gazing 2012. My guest on the show today is someone who has identified many bull and bear market cycles right. I've said this before, but I'll say it again. He's certainly one of my favorite stock pickers. Nilesh Shah of Envision. Nilesh, what a delight to have you back on ET Now. Thank you for joining us. Nilesh, the story of how Indian markets have moved in the year 2011, that was largely dominated by three factors: currency, Europe, and inflation. What will influence the script for 2012?
Well, the single biggest factor which will drive 2012 is going to be basically deficit. Clearly, all eyes of the entire global community is going to be basically on how government is going to tackle fiscal deficit. And to me, that's going to be the single biggest factor. Around it will revolve inflation, currency, outlook on markets, and of course the government's resolve to take certain hard decisions. So clearly 2012, the entire focus, according to me, is going to be on domestic fiscal deficit of the government. In addition to that, of course, all the factors which are there in the global environment, be it euro, be it an expectation of QE3, those are of course variables which will come in on and off. But the common underlying thread for 2012 is basically going to be the fiscal deficit of the government.
At 4,500 on the Nifty and at about 15,000 on the Sensex, what is the fiscal deficit number markets are pricing at? 5%, 6%, or 6.5%?
I'd say that markets perhaps are pricing in something like 5.5%. That's the kind of number which basically the street is expecting. That's not too way off from the estimates which have been put out by a lot of think tanks. The worry doesn't seem to be so much about FY12 because that's something which is kind of happened, but it's more about FY13 and what is the kind of roadmap that the government lays out for FY13 in terms of the deficit number, especially in the backdrop of an environment where commodity prices have not cooled off significantly, and if the food security bill is passed, then how is the government going to raise resources to basically keep the deficit under check? So it's going to be really some kind of an acid test for the government.
Secretly, you don't want the food security bill to go?
Well, my belief is that we as a nation don't seem to be yet fully prepared for it in terms of the delivery mechanism. I think the ability to fund that is still secondary factor. I think the primary factor is the worry is that do we have the ability to basically implement the food security bill. And I think clearly that's something which most experts, and I think as a common man, you tend to believe that we're still not fully ready to implement it on the scale on which it is envisaged.
So do you think the budget will be a make or break event for Indian markets for the year 2012 when the finance minister will be tabling his budget speech? He will also indicate a fiscal deficit number. Will that make or break the market for 2012?
From all the local factors, I think so. I clearly think that that's going to be the single biggest event that we have to really look for. And that's not just because of how our last 6 or 12 months have been, but it's that the next 6 to 12 months post the budget, which means the period post February 2012, and if you combine February and March, that's the spot during which we would be done with the budget. We'd be done with elections in some of the most crucial states, and therefore you clearly the next 6 to 12 months will be the most critical period for the government to take whatever hard decisions it needs to take. I'd say that that's the single, solitary and the last window available to the government to take tough decisions. And if the budget does not reflect that, then according to me, that's basically going to be an inflection point.
I'm surprised you're not using the word interest rate at all.
Because to me, interest rates is again a derivative of deficit, because it's very simple that if the government ends up with a deficit which is much higher than what it can support, it would have to be funded by borrowings. I mean, of course, one way to fund it is through taxes, but in an environment where the economy is not doing too well, your ability to increase taxes is not there. Your ability to collect more taxes from the same base is also limited. So the only big option left is to basically fund it through borrowings. And when you fund it through borrowings, it has to result into higher interest rates. So I think clearly things like inflation, interest rates, etc. are all basically subsets or a result or a byproduct of basically the deficit.
So macros will dominate Indian markets in 2012, not micros.
Absolutely, because clearly at a particular level, valuations will get attractive.
Are they attractive?
I'd say that they're beginning to get attractive. I'd say that we're clearly in the value zone. We've probably just entered the fair value zone. And obviously, if we do head lower from the current levels, then I'd say that we'd probably go towards those bedrock levels that we have had over the last 10, 15
so
years.
So what would be a bedrock level? 4,000, 3,500?
My sense would be that any levels below 4,000 on the Nifty, I think is a bedrock level. I'd say that even around 4,000, sub 4,000, according to me, is kind of a bedrock level, because that would roughly translate into a Sensex of about 13,000, around 13,000, or maybe 13 to 14,000. And assuming a Sensex earnings per share of 1,100 or 1,150, you're probably at about 11, 12 times. Those are kind of levels of valuation range on a trailing earnings basis, which have not gone broken on a sustained basis, no matter how big the event is. So if you look at the last 10 to 15 years, the markets have found it very difficult to break those levels of 11, 12. They could have temporarily broken it for a day or two. But I'd say that levels of 11, 12 are fantastic levels. And it's got a very strong correlation with the yield on government securities, because assuming the yield on government securities to be about 8.5%, which is a risk-free rate, and if you were to kind of take an inverse of that, you'd end up with something which is called the P multiple, which is about, say, 11, 12, which means that at 11, 12 P multiple, you're basically getting Indian equities, okay, with all the future growth as a bonus. Now, growth could be sluggish for maybe a few quarters, maybe for a year or two. But over extended periods of time, we clearly know that this economy has the potential to grow, and corporate earnings have the potential to grow in double digits. So clearly at those 11, 12 P multiples, we're clearly saying that you're getting India with all the growth, the future growth, as a bonus.
4,000 Nifty, and let me use the poker terminology here. Would you say it's time to go all in?
Yes, I'd say that it's definitely time to go all in, and which means that if you've been kind of either cautious or neutral at levels of 4,000 and below, it's no longer, you don't need to be neutral. You obviously need to be cautious all along, but you don't need to be neutral. You've got to be below 4,000. I think valuations become so attractive that I'd say that you've got to be bullish.
So where are bargains in this market? Where is the typical Buffett trade in this market, which is to buy fear and sell greed?
Well, my sense is that even without getting into individual stocks, but probably a trade on the Nifty itself, when you're getting basically the large caps, the mega caps, as a basket at 11, 12 P multiple, I clearly believe that that itself is basically a typical value trade that you may say. Because as I said, that even if you were to kind of do a analysis for the last 5, 10, 15 years, clearly the Sensex has really not broken those levels, or if it has broken temporarily, and then of course you basically make serious amount of money at those kind of levels. Your ability to make good double-digit returns at those kind of valuations, the probability of a very favorable outcome, I'd say, increases significantly at those kind of levels.
I was looking at some old tapes, and exactly a year ago on the same forum, on the same show, you had recommended our viewers to buy HUL. My compliments, that stock has appreciated quite handsomely this year, so markets are down and HUL has gained. Is HUL still a preferred buyer for 2012?
I'd say that defenses will continue to outperform. There's no doubt about that. Clearly, because the macroeconomic outlook is still hazy, and HUL as a franchise is a perfect hedge against a weak macro environment. That of course doesn't take away the fact that valuations are expensive, valuations are very rich, and I'd say that it's hard to kind of really make absolute returns from HUL at these kind of valuations at a stock price of 400. You could probably end up with a 10% upside. But I'd say that it would still be able to outperform over maybe slightly a more longer time frame. I still think it has the ability to outperform. But would you make serious absolute returns from that? I'm not too sure.
So identify a large cap stock idea for us, and I'll keep this one open. Where to your mind the downside is 10%, which is 4,000, and the upside could be 30% in next 2 years?
Well, apart from, of course, the Nifty itself, but my sense is that if the markets were to correct 10%, my view is that most of the larger banks would also correct by about 10%, and
maybe more.
And maybe more. And we've been cautious on the banking sector, but I'd say that let's assume you take any of the big banks, whether it is State Bank of India or ICICI Bank. If you look at State Bank of India, for example, I think the consolidated book value, the adjusted book value on a consolidated basis could be between 1200 to 1300. Stock is trading below 1600, a 10% lower. In that band of between 1300 to 1500, you're getting something like a State Bank of India around its book value. Now, are there concerns as yet in terms of asset quality, NIMs being under pressure, and whether the whole big question that whether the entire banking cycle has turned? So I think, of course, these are all the negatives that you may point out as basically an investment thesis for some of these banks. But clearly, is there absolute returns to be made from some of these ideas at those levels? I tend to think so.
Markets call Nilesh Shah as someone who is a champ mid-cap stock picker. So spill your beans. What do you like in the mid-cap space?
Nikunj, the environment, I'd say, is still not very conducive for mid-caps. You may still find a mid-cap stock which is at, say, a 10p multiple. And there's nothing which stops it from going down to an 8p multiple or a 7p multiple because of liquidity and not so much because of fundamental deterioration. And you could see those corrections on very small volumes. And I think that's clearly the biggest challenge. So when you are in a virtuous cycle, when the environment is a lot more benign, we clearly see mid-caps going up with very limited volumes. And I clearly think that when the tide turns, you definitely see mid-caps getting hit because on low volumes. So that's one. Two is, clearly when the tide turns for the positive, you clearly see that it's the large caps which lead first. And therefore a better trade sometime in 2012, when you clearly believe the valuation is attractive, is probably to play the large caps first and then go about selecting your mid caps. Because I think the risks in mid caps, even from a balance sheet, I think the balance sheet related risks in mid caps are substantially higher compared to the large caps. So my sense is that it's not that you shouldn't be watching out for mid caps, but maybe your first trade has probably got to be biased towards large caps versus mid caps.
The 3 Ds which have worked for the year 2011 are dividend, defensives, and diversification. What could work for 2012?
Well, 2012 again, I wouldn't be surprised if it's again the 3 Ds which are at work, and I clearly think that these 3 Ds by and large work when you're either in a sideways market or you're in a kind of a bear market. And so therefore I clearly believe that for 2012 the trade could be large caps, where you probably just got to be focused on those big names and be focused on that irrespective of course the dividend yield or the diversification. I'm not sure whether being too diversified also helps, because what happens is that you can probably afford to be diversified in a bull market, but in a bear market you've got to basically do your homework so well and have those very limited number of positions which you can monitor even better given the kind of macroeconomic backdrop that we are all today in.